You know who Blackstone are, a financial titan dedicated to swallowing the world whole, and with about $1 trillion worth of assets under their control, they are the largest alternative asset manager the world has ever seen. Now, I could sit here and tell you about their evil doings, how they're monopolizing the residential housing market, and even about their use of child labor, which has recently been exposed, but we all know that Blackstone is immoral. What most of us don't know is that they are also on the brink of collapse, and every day they get closer to that final point where they will fall completely apart. It's almost old news at this point, but Blackstone's flagship investment product, their real estate investment trust or REIT, has been suffering from a slow but steady bank run for 5 months at this point. In November, they had to close their doors to their investors, and when people came asking for their money back, Blackstone just said no. December rolled around, and again they refused to allow their investors to withdraw their capital. January, and there was no change. February, nothing new, and now we know the same has happened during March. For 5 straight months, Blackstone investors have been running for the doors, only to find them bolted shut. Now, many people will like to point out how this isn't a bank run because Blackstone isn't technically a bank, or they'll point out how Blackstone have it written into their contracts with their investors that they're allowed to do this and that the investors have no legal recourse. But none of that changes the facts that Blackstone's flagship $100 billion REIT is dropping in value, and investors are trying to get out with everything they've got. And as if that wasn't enough, last month we got news that Blackstone had officially defaulted on their debts. They were due to repay a $562 million bond in early March, and they just failed to make that payment, and now they've defaulted on 2 more pieces of debt. This is debt that they owned on a portfolio of loads of different property, but the slow but steady decline of property prices means this debt is unprofitable, and now Blackstone can't afford to pay it back. They went to their bondholders and begged and pleaded for an extension, but their debtors refused, probably not realizing just how bad things had gotten for Blackstone. Now, Blackstone are claiming that there's nothing to worry about, that this debt relates to a small portion of the Sponder portfolio, one of their subsidiary companies, and that they continue to have full confidence in the core Sponder portfolio and its management team. But if this is no big deal, and if Blackstone is totally solvent as they claim, why didn't they just pay the debt off? If $562 million is just pennies to them, why did they default on this debt? These lines just don't add up until you hear the next scandal that I broke in my previous video. Blackstone's CEO and founder Stephen Schwarzman was paid out $1.27 billion in 2022 for supposedly generating Blackstone so much in profits. And Blackstone paid out over $5 billion to their other shareholders over 2022 as well. Now, how is it possible that Blackstone had to lock their doors to stop their investors from leaving in November, and just a couple months after 2022 ended, they defaulted on a $500 million debt, if the business is so profitable that they can afford to give out $5 billion in dividends? The answer is sadly corrupt accounting rules, just like how SVB's collapse really came down to corrupt accounting rules. Blackstone is allowed to value their assets however they see fit. If they buy a building for $100 million and they claim a year later it's doubled in value, well then it's worth $200 million, and Blackstone has profited $100 million, and they can give those profits out to their shareholders. And they did this repeatedly over 2022. They continually increased their valuations of their properties right as property prices around the rest of the world started to fall. Now, there are 2 possibilities here. The first is that Blackstone really is special, that they are the most incredible property investors the world have ever seen, and even as average property prices in New York fell by 6%, Blackstone's picked the right ones and saw their value increase by 5%. Or there's the most likely outcome, that Blackstone are simply lying about their valuations, booking false profits and looting their investors for all the cash they can. Now, at this point, you have to ask yourself one very simple question. Why have you not heard about this from the mainstream media? Why has the legacy news not been covering this? Why don't they tell you about Blackstone's bank run? Why didn't they tell you about Blackstone's default? Why didn't they tell you about Blackstone paying out their CEO $1.3 billion? Sadly, the answer is very simple. They don't want you to know. They don't want you to see this. They want you to walk around like nothing is happening. You simply cannot trust these media outlets to educate you on what's important, but I do have a solution for you. My 100% free email newsletter, Stoic Markets, where I reveal all and expose exactly what's going on behind the scenes. It's free, you can unsubscribe anytime, and signing up helps support me and allows me to keep exposing the truth, but more on that later. Now, this is where things get really weird, because the American banking crisis has started and Blackstone seem more tied up in this ordeal than they'd like you to believe. It began just a few days after Silicon Valley Bank began to collapse, when Stephen Schwarzman, the CEO and founder of Blackstone, rushed to the media and assured everyone that everything was all well, that there was no banking crisis and SVB was fine. Of course it wasn't, and Blackstone in the end were even reported to be considering buying out SVB's loan book in an attempt to grow while the other banks collapsed. And this would have been no small feat, as their loan book was valued at around $74 billion, so the fact they were even considering this tells us they were involved to at least some degree. A couple weeks passed and Schwarzman then comes out with more statements trying to defend the entire banking sector, and he literally said, "The banking system is not in any type of conventional crisis." Now, I don't know about you, but I would absolutely consider multiple bank runs and multiple bank collapses after hundreds of billions of dollars of paper losses a conventional crisis, but he goes on to elaborate and states that this was actually a technological crisis. This crisis was caused by people on iPhones and other devices hearing on social media that some bank might be in trouble. Now, this sounds like it might be valid, but this isn't a gotcha to those screaming collapse, because this is what bank runs have always been: people running for the doors and panicking. iPhones have just sped the process up, but it actually starts to get weirder because next we see JP Morgan try to prop up Blackstone. You heard me right, JP Morgan. But back in November, Blackstone's bank run began as the institution saw its investors flee by the door as they had to lock everything shut, as we've already established. And this was bad news to anyone with even a single brain cell, but JP Morgan decided it wasn't even worth commenting on. In fact, JP Morgan in November just pretended this didn't happen at all, and they decided to declare that Blackstone was their top pick for financials in sight of a potential Fed pivot. An odd position to take considering how just weeks prior Blackstone's own investors were screaming and crying to get their money back, but JP Morgan held firm, and come January, they reiterated that exact same point, claiming that Blackstone is the best in its class and that we should all go buy Blackstone stock and give them our money. Now, had Blackstone's bank run been a one-off, you might say fair enough, but Blackstone has had to halt their withdrawals every single month since November, including December and January, which means JP Morgan have witnessed this situation continue to get worse, and they have continued to ignore it. But then we have the inconvenient truth that Blackstone just defaulted on one of their debts worth over $500 million as already established, and still JP Morgan are holding firm, claiming all is well and that Blackstone is actually the best firm around. It's simple to see that this just doesn't make sense, and JP Morgan are clearly trying to ignore the problems Blackstone are seeing, and what makes this so much weirder is that JP Morgan spent the last few months doing the exact same thing at the exact same time with Silicon Valley Bank right before it collapsed. This document here shows JP Morgan's research determining that SVB is a brilliant business, a brilliant bank, and a brilliant investment that's going to make all their clients rich. Now, I'll save you the trouble of reading it all, but the important bits are that JP Morgan claimed the causes of SVB's collapse were actually good things. This section here states how the tightening monetary environment means startups are going to struggle and run out of cash, and that will force them to raise more money, which means larger deposits for SVB. Of course, that actually turned out to be the total complete opposite, but that didn't stop JP Morgan from lying to their investors. They tried to drive capital into SVB prior to its collapse, claiming it was actually a business worth $375 per share, while today it sits at 99.9% lower than that at less than $1 per share. At this point, you have to ask a very simple question. Why did JP Morgan try to convince the world that SVB was the best bank around right before they collapsed? And why are they claiming the same line regarding Blackstone while conveniently ignoring every single one of their problems? It should be abundantly clear that you cannot trust these banks, and the fact that legacy media institutions are allowing this fraud to go unchallenged means you can't trust them either. Every single thing that we've looked at here today is public knowledge and should be easily accessible for any willing journalist wanting to expose the truth, yet all the mainstream outlets remain eerily silent. Even YouTube is making active efforts to disrupt this flow of information. Over a month ago now, I created a video exposing a secret hedge fund that exists to predict black swan crashes and what they're expecting next, and YouTube has had the video demonetized, age restricted, and shadow banned twice without any infractions on their content policies, forcing me to take the video private. Now, thankfully, I still have my email newsletter, and in exactly 7 days, I'm going to send that video out to all of you so that you can see what YouTube doesn't want you to. This is the only platform that I can ensure remains 100% censorship free, funnily enough, no matter what YouTube or CNN or any other media platform tries to do, they can't stop me from sending you an email exposing exactly what's going on. And this is all run for free through my email newsletter Stoic Markets. It is one click away to sign up. It's 2 to 3 emails a week explaining all that the mainstream media wants you to miss, and you can always unsubscribe instantly if you want to later. So make sure to check out the link down below for Stoic Markets if you want to stay informed. But as for Blackstone, it seems they are losing confidence in their business model and they just might be starting to panic. Over the last month or so, Blackstone first announced an attempt to raise a further $10 billion for what they call tactical opportunities, the idea being that they can buy up depressed assets while prices are in the depths during the coming recession. But this raises the question, what if they're just trying to raise capital to keep themselves liquid and to stop them becoming the tactical opportunity for a better placed firm? And in another unexpected move, Blackstone announced that they are pushing for non-institutional investors for the first time ever. The company has always focused on the big fish, the hedge funds, pension funds, governments, and billion-dollar businesses, but now they're throwing their entire playbook out the window by targeting individuals instead of institutions. Again, this could be a non-story, but when taken along with everything else that's going on with Blackstone, this is totally out of character. This screams of a business desperate to raise capital from anywhere they can, because if they don't, there will emerge massive problems. And while JP Morgan keep trying to channel money their way and into Blackstone, other banks are doing the opposite, with Barclays downgrading Blackstone after they repeatedly blocked their investor withdrawals, and with the firm officially defaulting on their debt, who knows which other banks will now follow suit next. And of course, this all comes back to the fact that Blackstone has made huge profits from its real estate investments over recent decades, and now the real estate market is falling apart, leading to independent news sites like this one speaking out about Blackstone's failure to repay their debt and what it claims is a larger mortgage default crisis. Blackstone used to have more money than they knew what to do with, which is how they bought up over $120 billion worth of real estate over the matter of just a few years, and now over the course of a few months, it's all come to a grinding halt, and now they're selling properties instead of buying them, like one of their flagship properties in London worth £395 million. And the craziest thing about all this is that this video is literally the opposite of clickbait, as their failure to repay debts is worse than I originally made out. Yes, Blackstone have actually defaulted on their $562 million bond based on Finnish and European offices, but they've also been forced to enter special servicing of 2 other massive bonds, which means they couldn't abide by the original repayment terms. How big are these 2 other bonds? Well, one is based on New York apartments and is worth $270 million, and the other is based in Las Vegas and is worth $325 million, meaning Blackstone is experiencing a mortgage crisis as we speak that is already larger than $1 billion, and it's just getting started. And if they can't repay these loans, I guarantee there are more out there that they won't be able to repay either, because they're in over $50 billion of debt. And when these maturity dates come through, when Blackstone is expected to pay the principal back, that is when all hell will break loose. And to top it all off, Blackstone is getting more and more heat from ordinary people every day. They came under huge amounts of fire after it emerged they were using their billions in capital to buy up entire single-family home neighborhoods, pricing out normal people who have ever been able to buy a house, and they were doing this all over the world in countries that you probably didn't even know they operated in, and eventually this evolved to the point where the entire business model had to be dropped because the backlash was just so great. Of course, they're still doing it where the public backlash isn't so great like in the UK, so it's clear this isn't a problem with the investment thesis, rather just with the optics. Now, the most recent scandal Blackstone is facing, well, it turns out that their portfolio companies have been exploiting child labor, and it isn't like Blackstone can claim ignorance or claim that this is just the nature of some poorer countries around the world, because this didn't happen in China or sub-Saharan Africa. It happened in the United States. It happened in Wisconsin. The fact that a $1 trillion American institution utilizing child labor in the United States isn't front page news all over the country should alone be a scandal big enough to shake the entire world, but the interests of institutions like Blackstone are just so great that the media does as they're told. You can stay up to date with what's really going on though through my 100% free email newsletter Stoic Markets, which is dedicated to exposing the truth and doing so without any kind of censorship. I founded it, I run it, I write it every week, and so if this video has opened your eyes at all, I seriously recommend you give it a chance. You can always unsubscribe in the future, no questions asked. fast and it's 100% free. And if you want to know how I actually find this stuff out, how I research the markets, how I work out what's happening now and what's going to happen next, then you can check out Stoic Financial Freedom. You can literally look at my previous videos exposing Blackstone back in 2022, predicting this would happen while no one else saw a thing coming. Now, Stoic Financial Freedom is a course and framework dedicated to giving back to this community and teaching you to invest and see the markets like I do. You'll get access to over 50 individual lessons revealing to you how the world really works, how markets and risk really determine your wealth, but most importantly, how financial stoicism solves all these problems. And as a special thank you for helping me build Stoic Finance all these years, I've put together a condensed version of the course specifically tailored towards investors and my viewers at a fraction of the full price, just to say thank you and ensure you're getting the best deal possible. So if you want to learn more about Stoic Financial Freedom or Stoic markets, check the link down below. Or if you just want to watch another video exposing BlackRock, then click here.